All right, just want to welcome and thank you for joining us today for our lunch presentation on expanding through acquisition. If at any stage you're consider growing your business through acquisition, if that's today or in the future, you are in the right spot. I want to also just take a minute and welcome our BNMA members. Thank you for joining us today. I'm Carolyn Powell, Business Development Director here at Tronconi Segura, and I'll be your host today. Just to point out a couple things, the toolbar to the right of your screen, we do have a handout section with today's presentation if you want to download that, and also Mark's full bio is in there. Also in that toolbar, if you have questions, you can put them in the question box. We'll get those answered throughout the presentation and any at the end. And then the chats, you can just send me a note, let me know that the audio is correct. You can see me, you can hear me, you can see the slides. So that is in your toolbar on how you can interact with us. At the end of the presentation today, we will also send you an email with a survey. Give us feedback of how the presentation was. If you have any additional questions, if you want to set a meeting with Mark, and if there's any other topics you would like to hear on, feel free to put those in the post-webinar survey. So we're going to get started today. Again, Tronconi Segura and Associates is a certified public accounting and business consulting firm. Mark Ferm is a CPA with over 20 years experience here at Tronconi Segura and over almost 30 years in the public accounting industry. He has a diverse experience with domestic and multinational companies in the areas of mergers and acquisitions, corporate governance, and financial reporting. And again, like I mentioned, Mark's full bio is in the handout section. Before I turn it over to Mark, and I want to get right to the presentation, just want to do a quick poll. So I'm going to launch this. Are you actively looking to make an acquisition? And I kind of gave a couple different timelines there. If you can give us some information, and then that way Mark can kind of speak to this, his presentation, and curve it to our audience this morning. So we got a bunch of people. Looks like most people are gathering information at this time, but we'll give it another minute for people to vote. I see Mark's making notes over there. We only have one poll today, so. All right, looks like most people have voted, so I'm just going to close it out. And again, 78% are gathering information today, Mark, and then we got 13% that are immediately looking to do an acquisition. So that'll help you with some of your talking points today. And Mark, without further ado, I'm going to turn it over to you and let you get started today.
Great, well, thank you. I think most of the people, from what we can tell, are on the East Coast. I do see actually a few clients, one in Colorado and a couple out on the West Coast. So other than that, appreciate, for those on the East Coast, appreciate you taking your lunch hour to spend the time with us to talk about growth through acquisitions. I'd like to also, as Carolyn mentioned, welcome our guest from Buffalo Niagara Manufacturing Alliance and a special guest, my dad. Gordon Ferm, welcome. So, based on the invitation list or the people that are attending today, we also seem to think that many of you are strategic buyers. So I've tried to fashion a lot of my commentary on strategic buyers. Those are looking to grow by acquisition through acquiring other businesses versus financial buyers. We also deal a lot with private equity firms and other financial buyers. And some of their needs are different, although the concepts and some of the things that we'll talk about are very, very similar. So moving to the agenda, finding the right deal. And many times for those, again, strategic buyers are looking for the right deal. That's a sort of a magical question you have to ask yourself before getting into that process should find the right deal. And I think as you'll find in some of my commentary, my experience is the non-financial aspects of a transaction and finding the right deal are probably the most important. But a lot of times are ignored or forgotten. So when the nerdy accountants and the attorneys take over, it's all about financial, tax, and legal issues. But I think as we'll find out, there's many more issues that really make a deal right for you. What are sellers looking for? Each deal is different, so it's important to have some upfront conversations with sellers to find out. We'll talk about some of those elements that we find are important to sellers and provide some commentary there. Structure examples. What does that mean? Is, well, before getting into buying a business, is how am I going to structure it? How can I finance it? Is it through debt financing, through equity, or other forms of financing? So we'll talk about some of those and talk about some of my experiences and what the impact of those different examples could be. A typical transaction timeline, for those that have ever been involved in a sell side that's represented by an investment bank, they always say we're going to close in 30 days. And I can almost bet my house that it's probably never going to be the case, pretty rarely. So we'll talk about the timeline and setting up some realistic expectations in terms of what that might look like and the timing for that. And then, of course, what would an accountant do without talking a little bit about financial diligence and tax considerations? I could probably spend about all day talking about those two topics. So we're just going to focus on some high-level areas, some of the more significant issues that we've seen in our experience, and some of the things to maybe focus on. And then towards the end, we're going to leave it open for questions. But as Carolyn mentioned, we do in the toolbar, there's an area to either chat or post questions to. And if we see any of those come up as we go, we'll try to answer those on the fly. But if not, we'll leave some time at the end to answer some questions. So moving on to finding the right deal. So I think one of the most important things is finding a strategic fit. There can be many different aspects to consider in a strategic fit in terms of the people, the customers, the product lines, and so forth. But that's probably one of the most important, is to find a strategic fit and really try to define what that means for you as a buyer. What does strategic fit mean? We had one example. We had a client, so it was actually quite a long time ago, but they actually were looking to acquire a machine shop. They were a manufacturing company, and they would outsource a lot of their machine parts to a third party. And so what one of their objectives was, let's acquire a machine shop, and that'll allow us to do all the machining in-house and maybe bring some of that margin and cost savings into our business. And so they looked at a couple, and they actually closed on a deal. It's actually a pretty healthy company with good people, pretty good financial results. But then after the acquisition closed, what they found is that no one in their company really did operational due diligence. And they found that the machines used by the machine shop to machine parts really didn't fit their needs. And so the whole strategic reason for doing the acquisition was blown up after the deal closed. And the lesson of that story is, not only do financial and tax diligence, but operational diligence may be just important. But identifying that strategic fit, and that'll help define the types of businesses that you want to acquire. Culture is another big area here. Will their business practices and their culture fit into yours? I think that the more you desire to have a strategic fit, and the more that you want to integrate those businesses, the more important culture becomes. So you can blend those two organizations for future success. The strength of the management team and people, I think that's also important. I think that many of us deal with small and medium-sized businesses here in Buffalo, New York, or in Western New York. And so a lot of times we're dealing with small family-owned businesses. And to that extent, people become more and more important, especially if the seller is looking to retire in the not too distant future. If that seller is very ingrained in the business, you want to make sure that there's some key people behind him or her to be able to run that business on your behalf and to execute the business plan. Customer base. With many companies, one of the most important things that you acquire is a customer base. And how consistent is that? How sticky are the customer relationships? How close are those customer relationships? And how do we retain those customer relationships after the deal closes, especially if the seller, the relationships reside with him or her. It's important to understand those dynamics in looking at a specific business to acquire. But finding that right deal, are there customers that you want to get access to, customers that you don't currently do business with, customers that you can cross-sell your own products to. So again, an important factor in finding the right deal. So supply chain, this is another area that's a very, very common question now. With all the supply chain disruptions in the global marketplace and all the geopolitical issues going on in today's day and age, gosh, in the last 12 months, this may have been one of the most common issues that we've had to deal with in diligence to understand the supply chain. What issues are they having getting product over here, raw materials? Where is it coming from? Certainly, if you're dealing with a lot of suppliers from Russia these days, I think certainly something that you need to really take a close look at. But then just the timing of the supply chain and how long it takes to get product into the U.S. We're also seeing, interestingly, as a little bit of a sidebar, a lot of businesses are actually bringing more business to the U.S. so that eases up that supply chain issue. But again, supply chain could be an important factor here, especially in today's day and age. So consistency of earnings and cash flow. This is, maybe in some cases, very important to financial buyers, but strategic buyers, maybe not so much so. Maybe you're more interested in getting access to the customer base, getting access to key people, key processes, and market opportunities. But certainly, if you're financing a deal with acquisition debt, the bank's going to be interested in how consistent the earnings of the target are. So understanding that's a key aspect, and we'll get in a little bit when we get into the financial diligence on some of the important areas there. So strength of the balance sheet, understanding how strong is their working capital, how are they able to meet obligations as they come due, and give you a good sense of, do I need to infuse additional capital in the business after I close a deal? Or if their working capital is really tight, do I need to negotiate with the seller to make a concession on the purchase price to be able to strengthen that balance sheet? What is the multiple? I think that today the multiples still tend to be a little bit high. So it really depends on your appetite and what your goals and objectives are for how high of a purchase price for a particular transaction, how high that multiple is. We'll talk a little bit too about how that impacts deal structure and how you finance the deal, because obviously the higher the multiple, the more money you need to close the deal. And can you afford it? There's been so many instances where we've actually been called by clients or friends and other folks to help out with an acquisition, and they're on the doorstep of signing a letter of intent, and they don't have any sense of how they're going to afford the deal. Where's the money coming from? Is it coming from the bank? Is it coming from investors? And so sort of understanding that before you get into a long drawn out process, I think is also important. The significant risks and exposures, I think we'll talk about some financial and tax side, but environmental is a key area. There's various tax exposures that we'll talk about. I'll share a kind of an interesting example of a risk. So several years ago, our client was the buyer of a company down in the Washington, D.C. area. And, many times in these special projects, most of the time I do like to go on site, because seeing and hearing and just observing things can tell you a lot about a business. And so on this, we did this, we had a kickoff meeting down on location and did a tour of the facility. And I started noticing a lot of signs in Spanish, not only just the language, but also they were spray painted on cardboard boxes that, almost look like magic markers or crayons, just all different signs all over the place, almost like giving instruction to employees. So I asked a simple question of, how do you deal with employment verification and the legality of your employees? And you would have thought you could hear a pin drop in that room. Because what we found out later is out of 100 employees, they had about 15 employees that were undocumented. And this is a business that actually did work with the White House, surprisingly. So our client decided that wasn't the right fit for them. And it really didn't matter the terms and conditions and the purchase price and what the seller was actually ready to negotiate a lower purchase price because of this one fact pattern that we found. That my client decided, you know what, it wasn't worth the risk, especially dealing with, you know, the White House. So just one example of a risk to, you know, that we find in some of these opportunities. So what is the market opportunities? This could be another, you know, finding the right deal. What products do they sell? Are they compatible with yours? Different customers you might be able to get access to, different geographies, both nationally and internationally. So understanding what that strategic fit is again also encompasses that the market opportunities. And there could be some situations where you're looking for synergies. So additional production space, skill sets of people, equipment, and marketing and sales. Are there opportunities to combine marketing and business development teams to be able to cross-pollinate product lines and be able to sort of increase revenues for both businesses and make things more profitable? In other words, you know, 1 + 1 doesn't equal 2, it might equal 3 when you combine the two businesses. So synergies are important as well. So what are sellers looking for? Well, you have to find out. One of the key things I think we have to do here is have a lot of conversations up front before extending an offer, understanding what the seller is looking for. And one of the things I find out and it's not all about the money. And we're going to talk on the next slide here about some of the non-financial aspects of what the seller is looking for. And many times, and I would say even arguably most of the time, actually may be more important than the money. I'll give a couple of examples there. The other thing I think I find it's important as you're trying to find out what the seller is looking for, find out who the decision maker is. And it's not always obvious. You might think, well, geez, the one who owns the most shares, right? They'd be making the decision. But particularly in a family-owned business, many times, especially if the company was perhaps given to, say, family members or kids, if mom is still alive, find out who mom is and find out what's important to her. Because many times in a family business, she will be, you'd be surprised how often it is that she makes the ultimate decision, whether directly or indirectly. We had an example where one of our clients had really no inclination to sell. But when the mother decided that it was going to, the business, owning the business was going to cause problems with the grandkids, who was going to take over the business ultimately, the grandmother decided to sell the business. And the business sold probably 6 months after that. So again, I always try to find out who the decision makers are and what are they looking to get out of the sale of the business. So many times, some of the main topics that we hear from sellers are, what's going to happen to their people? Are they going to retain their jobs? You know, many of these people have worked for these businesses for many, many years, and the business owners have become very close. They go to their weddings, they go to their baptisms. You know, they're very close with their people, and so that's really important to them. And they're going to want to hear about that, what your plans are as a potential buyer. Family members, this gets tricky, because are there family members that are involved in the business? Are they productive and are they adding value? And do they want to stay? If they do want to stay, again, are they productive? And are they getting paid fairly? Are they getting paid more than they should? Or are they getting paid less than they should? So important aspects to understand. Will their legacy be intact? This is another big one. Company name, especially if it's a family name, is extraordinarily important. And then will the business and job stay in the area? I find this a very common conversation in small markets, especially Western New York. They really want to understand, are you going to keep my business here? There's a sense of community, a sense of, you know, we all say, you know, Buffalo's a large living room. And they really want to, and gets back into legacy and taking care of their people. I've heard of a couple situations, couple stories, local businesses that the business owner decided to give away their company. because they were too afraid that the business was going to get moved out of the area. And these are businesses that are worth 50, 75, $100 million that they gave it away to not-for-profits foundations because they want to keep the business here in Western New York. That talk about what's important. So as a buyer, how do I increase my chances? And this is really geared for situations where a seller's maybe talking to several different buyers. They could be represented by an investment bank. And so if I'm really interested in a specific business, how do I increase my chances of closing that transaction and competing, especially with high multiples? So in that process of submitting a letter of intent, it's being able to commit to the non-financial factors. We talked a lot about those. Again, people, legacy, names, maintaining jobs, maintaining the business here or it's whatever location it may be in. Is if there's non-financial factors that we talked about that are important to the seller, see, can we commit to those? Many times you can't commit to in writing, but certainly if you can get them comfortable that you're going to commit to those, you increase your chances of closing that deal or being the winning bidder. Demonstrating the ability to finance the deal. This is something, especially for small to medium-sized acquisitions, they're going to want to know where's the money coming from, and can you get me comfortable that that money is available, either through bank financing, through equity, through cash, whatever that might be. And we're going to talk about structuring the deal, different options, different tools we can utilize to finance a deal. But a seller's going to know specific to that, and the more cash that you can put up front, typically the seller gets more comfortable with more cash up front. Speed to close. So timing of closing a deal. Obviously, the longer that you take to close a deal, the more nervous the seller is going to be. But if you can commit to a timeline, and we'll talk about that timeline, and it's a reasonable timeline, I think all the better. And then giving the seller an attractive structure. And if we look to turn to the next slide here with the different types of elements of a structure. Cash on the barrel. So the more cash you can put at close, typically everything else being equal, seller obviously is going to want cash up front. Seller notes are another tool that buyers can use if there's a need to sort of gap the financing that's available. But a lot of times sellers don't like seller notes. They have to hold paper, and if there's bank financing involved, usually the principal can't get paid until the bank is paid. So many times it's not palatable to the seller. Earnouts. So this is where, in situations where the seller wants additional purchase price more than you're willing to pay, but maybe based on future performance, you can pay them additional purchase price if they prove it. So higher revenues, higher EBITDA, higher earnings, higher cash flow, whatever that measure might be. The issue I find with earnouts though is they get messy, and sellers also aren't particularly fond of earnouts, because if they don't own the business anymore, they can't control the outcomes. They can't control the financial outcomes for which that earnout is going to be based, and so that makes them nervous. And then holdbacks. Holdbacks are another feature. In other words, if you see a financial risk or an exposure, hold some of that money back until you prove that it's not an exposure. Usually those are very typical in a transaction, but you certainly don't want to make that holdback too large and extend that holdout too far out into the future. So I want to talk about structuring a deal, and this is just using this as a basis for discussion, because there's many different types of structures, many different types, obviously multiples and ways in which you can finance a deal. But I want to just sort of share a couple scenarios to illustrate a couple key points and some things to consider as you're looking at financing a deal. This is something that, again, I would encourage you to do up front and understand the financial and tax implications, cash flow implications, and what the implications are with your current bank. So in this example, we'll assume that the EBITDA is $3 million. The multiple for this deal is 6. It's actually relatively low in today's terms. But again, let's just make the assumption the purchase price is $18 million. So in the first scenario, we've come to find out that the bank is only willing to pay $9 million. That's 3 times EBITDA. That's a pretty typical benchmark for a bank, unless there's other collateral, other EBITDA that it can attach itself to. So, but typically a bank will do that. In this scenario, let's assume for a minute they're willing to lend $9 million. And they're also asking us as the buyer to put down 20%, so 3.6 million. That gives us 12.6 million. It's still a significant gap. Where's the money coming from then? So other tools that we had talked about is a seller note. So that seller note can come with it commercial terms, but usually if you can get a seller to agree to it, won't be able to get paid until the bank's paid off. It'll be subordinated to the bank. So again, whether or not the seller will accept that is one thing. And then what's commonly referred to as mezzanine financing. So this is debt in order to close the gap even further, alternative sources of financing. And as you can imagine, with alternative sources of financing comes with pretty high interest rates. So mezzanine financing can come with 12 to 14%, sometimes even higher interest rates. So the implications on your cash flow and the amount that you have to pay out to support that interest obviously is more than bank financing. And many times mezz financing, they may actually ask for a warrant to exercise to get part ownership. So there's some of those elements that you have to consider. Typically, if you can make it without mezz financing, I would usually recommend that you try to go without mezzanine financing. So in scenario 2, again, same thing with the bank, 9 million. Seller came back to us and said, we really don't want seller note. We're only able to afford 6 million. So that still has a gap of 3 million, of which we have to reach in the mezz financing market. So again, a much larger mezz financing liability, higher interest rates. And so again, you should cash flow that out carefully. And then in the third scenario, we as a buyer are just going to assume we don't have a lot of debt. We got some additional collateral we can add in. The bank's willing to borrow on a consolidated basis, lend to us 12 million, which only means we got to come up with 6. Sellers not want seller note. We really don't like mezz financing, so we're willing to put in 6 million into the deal, and that's a much simpler structure. So I think in scenario 3, a lot of times we'll find that more bank financing, usually there is more collateral, there could be some real estate involved, and so it allows us to borrow more money. So typical transaction timeline, this varies pretty wildly. I've seen deals that go on and off for 12 to 18 months. So this is just use a basis for sort of discussion today. And the theme really is to, as I mentioned before, trying to have a speedy close, but also take sufficient time in order to do adequate diligence. And so that initial contact and discussion with the seller, we talked about getting to know our sellers, what they're looking for. Take your time in doing that. And along the way, you can be also doing some preliminary due diligence and drafting your letter of intent or indication of interest, depending on the circumstances, and start to get to know the company a little bit better in that preliminary due diligence phase. At the end of that, if you're the successful bidder, then issuing and signing a letter of intent is really that next step. After which, confirmatory due diligence. In other words, the sellers provide a lot of information to you already, preliminary due diligence. Now we're going to confirm that information. So you get the legal diligence, the finance folks and accounting teams get involved in financial diligence. But don't forget about, as we talked about earlier, operational diligence, human resources, and IT, other key areas to take a look at. And then along the way, at some point, deal documents will start to get drafted. And then finally closing. Now, once closing occurs, everyone wants to celebrate for a bit, but there's still a lot of activity a lot of action items after the deal closes. So those post-closing activities, purchase price allocation, the buyer and seller usually have to agree to that for tax purposes. Working capital is usually a working capital target that you then true up after close. And then integration, of course, integration probably takes much longer than this timeline provides. But integrating that business is also an important factor and to try to map out what that plan looks like. So financial diligence, I always say find the magic. What's the magic? Magic is what makes the company worth something or what makes it most valuable. And so that could be customers, it could be people, whatever that might be, but whatever that magic is, make sure you do due diligence on it. I mean, I think it's probably stating the obvious, but sometimes, you know, people get so buried in the numbers and the details that they forget to take a step back and say, you know, do we think we're going to be able to maintain the magic after the deal closes? And so doing sufficient diligence there is really important. Strength of the management team, understanding who is behind the seller. Is it a strong finance team, a strong operations team? If that seller's, especially if that seller's going to be retiring, who's going to run the business on your behalf? The financing the transaction. We talked a lot about that, you know, understanding, okay, once we get a little bit better understanding the numbers, providing that information to the bank. Many times that comes internally, and sometimes that comes in the form of a formal report, either an internal formal report, or many times we're hired to provide a quality of earnings report to the bank that's used as part of the underwriting process. And then tax structure. We're at a separate section on tax, but the point I want to make here is two primary forms of the transaction are an asset deal versus a stock deal. Why does that matter for financial diligence? Well, typically in an asset deal, for the most part, you're not going to be assuming many liabilities, or at least not assuming the liabilities that you don't want. There are some exceptions to that. We'll talk about that on the tax diligence. But usually more diligence is required typically in a stock deal, especially with regard to taxes, because in a stock deal, you're usually inheriting all the liabilities for that particular transaction. A couple areas of focus, reserves. And we know that, at least looking at our list of attendees today, a lot of manufacturing companies, and certainly our guests from Buffalo Niagara Manufacturing Alliance, inventory reserves. They're all too often small companies, they don't keep inventory reserves. And so if you're looking at the strength of working capital and come to find out they have a lot of inventory that's not sellable, that's a really important factor to consider, inventory reserves. And sales tax. So we'll talk a lot more about sales tax in the tax diligence section, but there is a big risk with sales tax, and have they properly accrued for that? And then another area that I'm finding more and more that's creeping up in a lot of deals that we're looking at, customer deposits. There's lots of businesses that take deposits from their customers in advance, and a lot of deals are quote unquote cash-free, debt-free. So that says, hey, the seller, you have to pay off all your debt, and whatever cash is left over, you can take it. But if you've collected a lot of deposits from your customers, that then in essence is a liability. I have to perform the work. The customer's still going to expect me to perform that work as the new owner. But if you've taken all the cash, that's a liability. So it's something that I'm seeing more and more these days, a customer deposit issue. Commitments and contingencies. We're looking for lawsuits there. Are there any pending lawsuits? Do we have any commitments in regards to leases, long-term leases? And are we taking those over? Can we take those over? And then sales tax. You're going to hear me talk about sales tax. That's one of those things. It's one of those hidden things that always pops up that it comes to bite you in the end. And then environmental, particularly in the manufacturing side. You know, there's going to be probably environmental study required. That's something that probably the bank's going to require. So give yourself enough time to take a look at these sort of key items. Tax considerations. Will you get a step up in basis? A step up in basis, what that means is particularly in an asset deal, but you could do a stock deal and make certain elections, but a step up in basis means for tax purposes, I can step up the value of those assets. And what that allows me to do then post-transaction is amortize those typically and then hopefully as tax deductible items. And so as a buyer, I usually would want a step up in basis to be able to capture those tax deductions going forward. I'm going to pay a certain amount for that deal, and if I can get those additional tax deductions down the road, all the better. If I don't get a supplemental basis, I don't get the benefit of usually any tax deduction until I then sell that business. So there's a big difference when you can get a supplemental basis. So sales and use tax, talked about that. That's one of those hidden taxes that just no one thinks about until the end. And that's an area that's a high area of focus for us. We have a whole sales tax team that handles that for us. And one of the big questions, are your product sales subject to sales and use tax? We all know that in recent years with the Wayfair case, states are looking to collect sales tax where necessary or where applicable. It's a question of, is that business subject to sales and use tax? And if it is, are they collecting and remitting in the right jurisdictions? And I've seen deals crater because of the lack of importance placed on the sales and use tax area. And then state income tax nexus. If I'm doing business in other states, is the seller properly filing in those states? If not, what penalties are they subject to that I may have to pick up, particularly in a stock deal? Do I inherit those liabilities and have to pay those penalties and interest on their behalf? So looking at state income tax nexus is another key tax consideration. Looking at bulk sale tax, transfer tax, this is kind of in the sales and use tax area, but it's when certain assets, and it varies from state to state, that if you transfer certain types of assets, it's subject to a bulk sale tax, very similar to sales tax. We had a situation, a client that they were going to be subject to a big bulk sale transfer tax, and by appropriate tax structuring, we were able to obviate that sales tax, and it saved our client $1.8 million based on a pretty ingenious tax structure. And so again, important to understand what those taxes might be. Now they're hidden tax, although usually isn't that material, but if there's a lot of real estate involved, you have to look at the real estate transfer tax. That's another hidden thing that I think that people forget about. And then tax incentives. What types of tax incentives has the seller been able to enjoy the benefit of? One common example is pilot taxes. So in many areas of New York State, there's a pilot tax savings. And so if there's a change in control or an asset deal, might those tax savings go away? And what are the financial implications to that? So it's kind of understanding those tax incentives of what occurs on a change in ownership. So those are my sort of formal commentary. I don't know, Carolyn, if we can take a look to see if we have any questions here.
Absolutely. First of all, I want to just thank you that was a lot of great information. We do have time for questions. We have a couple in here, but for anybody that has a question, feel free to put it in the questions section that is in the toolbar to the right hand of your screen, and we'll get those answered today before we end things. So, Mark, you want to
I'll take the first one. Looks like the question is, can you comment a little more about the approach for potential environmental liability? So this is common, especially with manufacturing companies. Anytime you obviously dealing with caustic materials, paint booths is another. This is another reason why I like to go on site. If you see paint booths, you want to start to ask about environmental concerns. But usually, what happens with environmental liabilities is if you're any form of debt financing from a bank is likely going to require an environmental study. And as we all know, private insurance phase 1 and phase 2 studies. Usually, there's at least a phase 1 study that's done to find out what exposures might there be and how well managed is the operations that can sort of manage that environmental liability. So depending on the result of that phase 1, you then potentially get into a phase 2 environmental study. So the thing that I can mention there is give yourself enough time, because if there's an environmental study that's required, it obviously takes time. So that building into your timeline is important. Just to get an environmental study started and completed in phase 1, sometimes these days might be 30 days. And if a phase 2 study is required, certainly time after that. So if you think an environmental study, I think the most important thing is to the buyer and seller should discuss that well in advance and get that process going, you know, if you want to hit certain deadlines.
Great, thank you.
So then the second question, I know we have actually a third, maybe a fourth one. So do I need an appraisal for real estate and or fixed assets? It's a great question. That's a very common question. So I would say it depends. You know, it depends on materiality, how big, how much hard assets are you buying, and what's significant of real estate. I would say a couple of things to consider. A bank, again, if you're getting bank financing, the bank is likely going to require an appraisal if the assets are significant. That provides support for the collateral and other things. There's also tax implications to an appraisal. It's important to understand, okay, what are the tax implications and how can I maximize as a buyer the tax implications going forward by allocating the purchase price in a certain way. But in order to support that allocation, if you're ever audited, the tax authorities will require some level of support, whatever that support might be. Obviously, the more material specific assets are, the stronger the evidence is usually an appraisal, third-party appraisal. So that, hopefully I answered that question. Looks like we've got a few more here. So looking at EBITDA financials for the company, what other things should we be looking at besides that and cash versus assets? So, you know, I would say, in addition to EBITDA, you know, we talked about contingencies and commitments, off balance sheet liabilities, things that aren't in the financial statement. There's many times, especially for smaller deals, we get involved in situations where it's a cash basis or they don't have a lot of liabilities on their balance sheet. So it's kind of understanding those off balance sheet liabilities. Again, environmental, we talked about that. And I would say some of the non-financial areas, such as their customer lists. Is there a significant concentration? If you have a customer that makes up 90% of the revenue, that's obviously higher risk than we have a customer base where the largest customer is 10%. So those are just a couple examples, but certainly great question. So next question, when there is a customer deposit, how should that be handled? So I think that, you know, customer deposits, you can approach it in a couple different ways. You can, if the seller is willing to keep cash in the till, if you will, or keep cash on the balance sheet, up to the amount of customer deposits, that's an option. Sometimes it's not, that's maybe not possible, especially in an asset deal. You're usually not going to deliver cash. But, you know, the other option is to reduce the purchase price so that you then have to come up with less cash at close. But another elegant way is to work it into, no pun intended, the working capital true up. And so setting a certain target, excluding customer deposits, and at closing, you can then include as liability and therefore get trued up through that mechanism. So those get kind of a little trickier. So, you know, happy to, you know, follow up if you wanted to contact me on some of the other tools that we utilize to handle customer deposits. But great question. That's we just came across a situation where the deal valuation was about 11 million and there were customer deposits of 1 million. So a pretty substantial part of that purchase price. We had to get around the customer deposit issue.
Great. I
think that's it.
Right? Yeah, some good questions that came in. If anybody wants to reach out to Mark directly, his contact information is on the screen for you. And again, we will be sending that post survey out. So give us some feedback. And again, if you have questions, you can put it in there. If there isn't any more questions today, we will end a little bit early. Next month's topic will be sales tax audits and compliance on June 14th. And then we'll take a little summer break and be back in September. So but that will be our next one, June 14th. We'll see everybody again. Thank you for joining us today and have a great afternoon.